Hello, and welcome to Tracking Error, the podcast about money and markets. This is a Bridgewick Partners production. Let's get to it.
This podcast is for informational and entertainment purposes only and is not investment advice. Please do not take anything discussed as a recommendation. Contributors to this podcast may or may not have positions in the themes discussed. Do your own research and speak with a regulated financial advisor. Full disclaimer in the show notes.
Welcome. My name's Alex Lightfoot. I'm going to be your host for episode 1 of the Tracking Error podcast. No guest today, just me. We're going to have a bit of chat on current markets and then a longer term topic. If you do want to come on a future episode of the show, let me know. But first up, epic fury, the war in Iran and what that's doing in markets. Look, honestly, I've got nothing insightful to say on the situation in the Middle East. Not sure anyone does, frankly. On the human side, it's been awful and chaotic at best. On the market side, unsurprisingly, oil and gas up. 10 of the last 16 trading days, front month gas futures in Europe have moved more than 10% intraday. That hasn't just been down, there's been a lot of up as well. Risk assets down. Nothing crazy. S&P 500 is down like 4.5% since this whole thing started and is still up 18% over the last year for a bit of perspective. More interestingly though, rates are up and gold is down. Some second derivative stuff going on here. So let's focus on that. Starting with rates, and I'm going to use the UK gilt market as the case study. Huge move, absolutely massive move in UK rates. The 2-year yield a month ago was at 3.55%. It got to 4.55% earlier today before Trump backed off with some of the rhetoric hitting the headlines. 1% move in 2-year yields in a month is very big. Now, while direct energy costs account for 7% of the UK inflation basket, coming from fuel and then home heating, energy gets passed through indirectly as an input cost in a lot of other areas, namely food, transport, and then later from labour costs and from wage pressure. Now, it's super volatile relative to all of the other input costs. Like labour costs don't move anywhere near as fast or have that kind of shock aspect to it that energy does. And so it's often a leading indicator for some of these inflationary periods. In 2022, it was energy, of course, that kicked all of this off from that first period of inflation we saw. So it's not surprising to see rising prices back on the agenda as a result. We came into the year with the market expecting the Bank of England to cut rates 1 to 2 times in 2026. So looking to cut by 25 to 50 basis points, getting to a terminal rate of around 3.3% for the overnight rate in GBP. And that was pretty much true until the end of Feb. So that carried through the first 2 months of the year. Now, post-Operation Epic Fury, as the UK is a net energy importer and has very little gas storage capacity, this inflationary pressure has increased and built up. And over the last 6 months, the market expected UK inflation to average 3.3%. So actually where that terminal rate was expected to be. So the market expected 2-year inflation to be 3.3. It now sees it at 4.7. So it really sees that energy shock passing through an extra, let's call it 1.5% of price increases on average per year for the next 2 years. And so to counter that, the Bank of England are expected to hike at least twice in 2026 to get to an overnight rate of about 4.3%. So we've gone from the market pricing 2 cuts to 2 hikes. So overall, that's a 1% swing or a 1% move higher in rates, which is kind of how we get to that 2-year yield moving from 3.55 to 4.55. Now, energy prices up, inflation up, rates up. Add the uncertainty of all of that into the mixer is not good for growth, not good for equities, other risk assets. But that smells a bit like stagflation. That's not ideal. But a bit of perspective, bit of positivity, maybe. Now, the 20 to 30-year part of the UK gilts curve is knocking on the door of a 5.5% yield per year for the next 20 to 30 years. Now, sure, it's a very long time, and these bonds move a lot in price. So they'll move anywhere from 12 to sort of 25% for every 1% move in rates, depending on which bond you pick and how big the coupon is. But if you can kind of stomach that volatility, if you can find a low coupon gilt for that long, we're looking at tax equivalent yields well over 7% for a UK taxpayer outside of a tax wrapper, like an ISA or a SIP. 7% tax equivalent yield, like we're not far off competing with equities in what is meant to be the risk-free rate, i.e. the gilt curve. So that's super interesting. Second one, in terms of the big movers, is gold. So this morning it was down 8.8% in Asian hours, bottomed out at like 20 past 7 in the morning UK time. And since that time has now rallied about 7% from those lows. That's a big move. That's a huge move in a day, especially for a commodity like gold. Now, it has gone up a lot in recent times. So still, gold's up like 1.5% year to date, 45% over the last year, and 155% over the last 5 years. So it's moved a lot. And that kind of move lower and then bounce back indicates some deleveraging. So it might even be, one very large seller, fast and disorderly, kind of getting rid of their position. Maybe they hit some risk limits and needed to get rid. But that's a big move in something like gold. A little bit of a side note, Bitcoin is down 20% year to date. Gold's up a little bit, 2%. Since the war began, it's up 7.5% and gold's down 17%. This is not a comment on whether gold or Bitcoin are good investments from here, but simply that Bitcoin is definitely not digital gold. So I wrote a post about this in the newsletter around, the thing that gold is most closely correlated to is S&P growth. Not since the war began, clearly, but Bitcoin and gold are not very similar, actually, in terms of portfolio construction and kind of helping out. So that's where we are on market thoughts. Any comments? Let me know. I'd love to have a chat. But let's move away from the daily swings for a second, even though there have been some big ones. I want to talk index methodology. Interesting, right? Now, there's an 85-page document on the Standard & Poor's website that outlines their US indices methodology. Basically, how is the S&P 500 constructed as an index? Now, it's not the kind of thing to print out and read with your Negroni on a Friday, but it is important. Now, just in the 3 largest US-listed S&P 500 ETFs, there are getting on for $2 trillion of assets. Now, that $2 trillion, it doesn't include all of the smaller ETFs in the US. It doesn't include all of the passive trackers that are, in mutual fund format. It doesn't include anything listed outside the US, so the big London S&P 500 ETFs. And it also doesn't include the fact that many of the world's largest investors tend not to use ETFs because they don't want to pay the 7 basis points of fees. They do their own passive replication themselves. When you add all of that together, we are talking about tens of trillions of dollars of assets tracking the S&P 500 in kind of passive tracker format based on what they're told to from the index. That means that hundreds of billions of dollars move based on the index methodology changing and the rebalancing of that. So that methodology is incredibly important, and it's crucially important for retail who use these ETFs a lot. That's you and me. As a minimum, these kind of products are in our pension. Now, Standard & Poor's, MSCI, the FTSE indices, these providers were never meant to be investment managers. They were meant to give investors an idea of how their portfolio had done versus a sort of generic benchmark of assets, so they could see if their investment manager had done, a terrible job, an okay job, or a very good one. But ETFs have changed everything. Now these index providers, look, they're still not investment managers, but their decisions move money. How they construct these indices and how they make decisions on that, they certainly look and feel like investment managers, even though they're not. Now, in theory, that setup can work. In fact, it has worked really well. Just ask your average active equity manager over the last 10, 15 years. But you do really need to trust that methodology. You would want a robust process that doesn't change very often and isn't conflicted or likely to change based on external or commercial pressures, for example. Enter stage left, SpaceX and potentially OpenAI and Anthropic all looking to go public soon. And they're going to be offering a small amount of their shares. So they're going to have quite a small free float at the beginning. First up, NASDAQ are looking at changing their methodology for, and this is a quote, large and or newly listed companies to include those with small free floats. So they're not being around the bush. Next, Standard & Poor's outlined that index methodologies do evolve to ensure that indices continue to represent market segments they measure, to ensure indices remain investable. Now, to be included in the S&P 500 today, a company must be profitable on average for the last 4 quarters, be domiciled in the US, have at least 10% of shares available to the public, been listed for the last 12 months, and meet some market cap and liquidity criteria. Now, on day one, SpaceX is a US company, tick, and they're probably going to hit the liquidity metric, tick, and they're going to exceed the market cap, tick. But listed for 12 months, of course not, on day one. Profitable, no, and more than 10% free float. Well, Elon Musk's talking about a $1.75 trillion valuation, so they'd need to list 175 billion. That's a lot to take down if you're really looking at a 10% free float. More likely there's discussion around kind of 50 billion or so nowhere close to a 10% free float. So those three are not going to get hit for a while. So using the current methodology, SpaceX is not going to be anywhere near the S&P 500. And yet, there's discussion around whether the methodology should change. Now, if it does, whether the ETF provider or us as underlying investors, whether we like it or not, the ETF's going to end up holding this stuff in serious size. And assets actually held inside an ETF are arguably not free float anymore, because ETFs only sell if another market participant sells and reduces the price of that security versus the whole market to get it rebalanced inside the ETF. Now, maybe SpaceX, OpenAI, and Anthropic are once in a generation kind of companies, and they should be 100% of the index because they're going to be the only 3 companies that exist. Maybe, but that's not the point here. The point is that investors' allocation decisions are increasingly driven by an 85-page document that I know you haven't read. This one's worth watching. It feels kind of disappointing, I think, if they do change their methodologies and this lot get in there for commercial or external reasons. Let's see. Finally, big disappointment. In other news, Arsenal wilted at Wembley against Man City in the League Cup at the weekend, and we have to wait a full 2 weeks for redemption. Anyway, up the Gunners. Go well.